Hello everyone, and welcome. Today we're going to demystify a very specific but incredibly important provision of the new Income Tax Act 2025. We're talking about Section 115, which deals with losses from a specified activity. Now, I know it sounds niche, but if you get this wrong, the financial impact can be huge. So let's dive right in.
So to get us thinking, let's start with a classic real-world scenario. Imagine your client has a very profitable textile business, doing really well. But as a passion, they also own and maintain racehorses. And, well, that venture is losing a lot of money. The immediate question you're going to ask is, great, can we use these horse racing losses to bring down the taxable profit from the main business? It seems logical, right? Well, this is the exact question that Section 115 is designed to answer.
All right, here's our game plan for this explainer. We'll kick things off by defining what the law actually means by specified activity. Then we'll get into the nuts and bolts of Section 115 itself. We're going to walk through a solid practical example, cover the compliance points you absolutely cannot ignore, look at common mistakes so you can avoid them, and then we'll wrap it all up with the key takeaways.
Okay, first things first. As you know, in tax law, words matter. The definitions are everything. So before we get into the rules, let's get crystal clear on what we're actually talking about.
So the core term here is specified activity. And, the Income Tax Act 2025 is incredibly precise about this. It's not some broad, vague category. It means one thing and one thing only: the activity of owning and maintaining racehorses. That's it.
And just to drill down even further, the Act then defines racehorses. These aren't just any horses. They are horses specifically owned and maintained for the purpose of racing. This distinction is crucial because it basically puts a tight boundary around Section 115, confining it strictly to the business of horse racing.
Okay, so now we know the what. Let's get to the how. This is where we break down the legal framework of Section 115 and really understand how it tells us to treat these very specific losses.
And here it is, the fundamental rule, the absolute heart of this section. The law essentially creates a ring fence around this activity. Any loss you make from owning and maintaining racehorses can only be set off against income from that same activity. You cannot, I repeat, cannot use it to reduce your tax on any other income. Not your main business, not your salary, not capital gains, nothing. It's completely isolated.
Now, it's worth pointing out, especially for the seasoned professionals watching, that this isn't some brand new concept. This principle should sound very familiar from Section 74A of the old 1961 Act. The new Section 115 in the 2025 Act is really just a continuation of that same logic, which is good because it provides consistency in the law.
So the process for handling the loss is a clear two-step sequence. Step 1, in the current year, you take the loss and set it off against any income you might have made from the same activity, let's say from stake money. Step 2, if the loss is bigger than the income and some of it is left over, that unabsorbed loss then gets carried forward to future years.
But, and this is a huge but, how long can you carry it forward? The law is very strict here. You have a maximum of 4 tax years, and that's 4 years immediately after the year the loss happened. Once those 4 years are up, any loss that's still left over, well, it's gone. It just lapses.
Okay, theory is great, but let's be honest, nothing makes tax law clearer than seeing it in action with some actual numbers. So let's run through a practical example.
Let's meet our taxpayer, Mr. Singh, and we look at his tax situation for the financial year 2026-27 under the new Act.
All right, let's break this down. Mr. Singh's textile business is booming, a profit of 50 lakh rupees. Awesome. Now over to his horse racing activity. He made 5 lakhs in stake money, but his expenses were 15 lakhs. So that's a net loss of 10 lakh rupees from this specified activity. And here's where Section 115 kicks in. See that 10 lakh loss? It cannot touch his business profit. The ring fence is solid. His taxable business profit stays at 50 lakhs. That 10 lakh loss, it just gets carried forward, waiting for some future income from horse racing to absorb it. This example just perfectly shows you how isolated this loss treatment is.
Understanding the law is half the battle, right? The other, equally important half is compliance. So, let's talk about the essential paperwork and filing rules you need to follow.
So for compliance, a few key things. 1, you absolutely must keep separate, detailed books of accounts just for the horse racing activity. 2, you need to document every single expense. But this last point, this one is the absolute deal breaker. You must file the income tax return that declares this loss
on time within the due date. I cannot stress this enough. If you miss that deadline, your right to carry forward the loss is gone. It's not a penalty, it's not a fee. The right is simply forfeited. It's a non-negotiable condition.
Now, given how strict these rules are, it's actually quite easy to make a mistake. So let's look at the most common pitfalls so that you can steer clear of them. So what are the traps that people fall into over and over again when they're dealing with this section? Let's shine a light on them right now.
We see 3 big errors pretty consistently. First, the illegal set-off. This is trying to use the racehorse loss to reduce tax on other income. The law just flat out says no. Second, trying to carry the loss forward past that 4-year limit. The clock runs out. And third, and honestly this is the most common and painful one to see, filing the return late. So many people think, oh, I'll just file a belated return, it's fine. It's not fine. As we just discussed, you completely lose the right to carry that loss forward.
All right, we've covered a fair bit of ground. Let's boil it all down to a few simple, essential takeaways that really summarize everything you need to know about Section 115.
So if you only remember 4 things from this session, make it these. 1. Think ring fence. Horse racing losses are completely isolated. 2. The set-off is highly restricted, only against horse racing income. 3. The clock is always ticking. You have a maximum of 4 years to carry it forward. And finally, number 4, the gatekeeper to all of this, mandatory timely filing of your tax return is what gives you the right to carry the loss forward in the first place. Get these 4 points down, and you've mastered the core of Section 115.
And that brings us to the end of our deep dive into Section 115. I really hope this explainer has made the treatment of these specified activity losses much clearer for you. If you found it helpful, please do us a favor and like, subscribe, and share it with others who might benefit.
And just a quick reminder, this video is for educational purposes only and is not professional advice. Tax laws change, so it's always best to consult with your professional advisor before making any decisions. This is an AI-generated educational video.